David, I want to go to you right now on use of cash. How do you avoid the pitfall of value traps when you study free cash flow?
The single important thing about free cash flow is you have to grow it. So it's not about how cheap it is on a price to free cash flow basis. It only works if you can grow. Now, you don't have to grow a lot, but you have to grow it modestly because otherwise the future value of the company isn't going to go
How do you
up.
grow it if we're in a time where we're going to do a reset on revenue growth as well? Up the income statement. We're not Make America Great Again and buoyant as we were. So where does that growth going to come from?
You have to find companies who individually have demand drivers, demand growth for whatever their products or businesses are. Now, it's interesting, there's a dichotomy right now, and it's been for the last year, between growth stocks and value stocks. If you're a growth stock, it's all about revenue, no care about earnings. If you're not a growth stock, it's the exact opposite. It's about growing profits. So growth stocks, they can undersell, they can lose money as long as they keep that growth rate up, like Salesforce.com. That's the issue. For value stocks and free cash flow, you have to grow modestly. And the U.S. economy can support mid-single-digit earnings growth.
David, when do you expect, if you're expecting a recession in the U.S., would it come in 2020, would it be after 2021, or would you completely discount the possibility of a recession in the next 3 years? Oh,
that's a tough question. I will say we really can't see it at all for the next 12 months. There is no indicator, and of course, you know, GDP-wise, it would be nearly impossible to have negative GDP growth right now. But could it happen in late 2020? It is possible. It really depends on a whole bunch of macro issues. The good news is the Fed, which was one of the big clouds, is now going to be restrained, patient. So that was one of the factors that caused the dip in December, was the fear that the Fed could have caused the recession. That's not an issue now. So now we're looking at world macro factors. The trade deal clearly, although that's now being discounted more as a positive. So we don't see it. The growth of the economy doesn't end because of the length. This is one of the longest growth recoveries we've ever had. It's really about the conditions. So as long as inflation is moderate, monetary policy is moderate, it can go on a while. And again, GDP at 2 to 2.5% is sustainable given what we see. So it's out there. You worry about it. But the opportunities are finding the companies that have not been bought up based on this economic growth. So it's individual stocks.